When people hear the words market crash, they imagine chaos, screens flashing red, traders screaming into phones, and headlines declaring the end of prosperity. But history tells a different story. Every major collapse, from 1929 to 2000 to 2008, hasn't just destroyed wealth, it has transferred it. While the masses panicked, a small group quietly became richer than ever. And now, as we move toward 2026, the same pattern is forming again. Global debt is at an all-time high. Stock valuations have broken historical limits. Governments are printing money to keep systems alive, while the foundation beneath them begins to crack. The experts say there's nothing to fear, just like they did in 2007, right before the world imploded. But beneath the calm surface, the numbers are screaming a warning. The next great reset has already begun. This isn't a prediction, it's a mathematical inevitability. The question isn't if it happens, it's when, and more importantly, who will profit when it does. Because crashes don't destroy wealth. They move it from the emotional to the disciplined, from the fearful to the prepared. And if you understand how this next cycle works, you won't just survive the 2026 crash, you could become one of the few who get rich from it. To understand what's coming in 2026, you have to look backward, because the economy moves in cycles, and those cycles always rhyme. Every major crash in history, from 1929's Great Depression to the dot-com collapse in 2000 to the housing meltdown in 2008, followed the same invisible script. It always begins with euphoria, a time when everyone believes they've discovered a new formula for endless wealth. In the 1920s, people borrowed money to buy stocks they didn't understand. In the 1990s, they poured savings into internet companies that didn't earn a single dollar. And in the 2000s, they signed mortgage papers for homes they could never afford. Every time, the logic was the same. This time is different, but it never is. The next phase is denial, the calm before the storm. Warning signs appear, but experts and television pundits dismiss them. In 2007, when cracks appeared in the housing market, the Federal Reserve declared the subprime issue is contained. Months later, the global financial system collapsed. In 1999, economists said tech stocks could only go higher. Within a year, the Nasdaq lost 78% of its value. Even in 1929, newspapers reassured readers that the worst was over, just days before the real crash began. Human nature doesn't evolve as quickly as technology, and that's why the same mistakes repeat. And then comes the reckoning. The euphoric bubble bursts, fear replaces greed, and the system resets. Banks close, jobs vanish, families panic. But beneath the destruction, something extraordinary always happens, a massive transfer of wealth. The people who prepared, those who had cash, patience, and courage, step in when everyone else is running away. They buy world-class assets at bargain prices. During the 2008 crash, million-dollar homes sold for $300,000. During the dot-com bust, Amazon fell from over $100 to just $6, and Apple traded for less than a lunch. Those who recognized the pattern didn't just survive. They built fortunes that would last generations. Now, as we approach 2026, the data suggests we're nearing the same stage again. The Shiller-Cape ratio, which measures how expensive stocks are compared to their earnings, is at its second highest level in recorded history, surpassed only by the eve of the 2000 crash. Corporate debt has hit record highs. Consumer credit card balances are growing faster than wages, and U.S. government spending has ballooned beyond levels once thought impossible. Yet, if you turn on financial news, you'll hear the same soothing message. The economy is strong, there's nothing to worry about. That's exactly what they said before every collapse. The names and technologies may change. Railroads, dot-coms, crypto, AI, but the psychology never does. It's the same story told through different bubbles. A nation falls in love with a fantasy of infinite growth. Debt piles up, optimism peaks, and the system stretches to the breaking point. Then, with mathematical certainty, It snaps. Every crash in history has one defining feature. It punishes the unprepared and rewards the disciplined. It's not about intelligence, it's about awareness. The investors who saw 1929, 2000, or 2008 for what they were didn't have crystal balls. They had patience. They watched the herd rush toward cliffs of greed, and when the fall came, they were waiting at the bottom with open hands. Now the pattern is repeating. The euphoria has peaked, denial is everywhere, and the reckoning is closing in. The next question isn't, will it happen, but who will be ready when it does? If you listen closely, you can already hear the tremors beneath the surface. Manufacturing output has started to shrink for the first time in years. Credit card defaults are quietly rising. Commercial real estate vacancies are climbing to levels not seen since the 2008 financial crisis. And yet, turn on any financial channel, and you'll hear the same reassuring chorus: the economy is strong, unemployment is low, and there's nothing to worry about. It's the same false calm that comes right before every financial earthquake. Behind that calm facade, the smart money, the people who never speak loudly but always act early, are already moving. Warren Buffett's Berkshire Hathaway is sitting on over $300 billion in cash, the largest cash position in the company's history. That's not confidence, it's preparation. Major hedge funds are buying gold, treasury bonds, and defensive stocks while trimming their exposure to overvalued tech companies. Institutional investors are quietly shifting capital offshore, hedging against currency devaluation. Meanwhile, the retail investor, the everyday person, is doing the opposite. They're still buying high, borrowing more, and believing that the good times will last forever. That's how every cycle ends. It's a cruel paradox. When optimism feels safest, danger is already here. The same thing happened in 2007, when home prices hit their peak and mortgage brokers were giving loans to anyone with a pulse. The same thing happened in 1999, when day traders quit their jobs to trade internet stocks from their bedrooms. It's happening again now, as millions pour their savings into AI-driven funds, meme stocks, and crypto hype, believing they've outsmarted history. But you can't outsmart human nature. Greed always blinds before it burns. Look closer, and the signs of strain are everywhere. Corporate bankruptcies in the US have surged by over 40% compared to last year. Office buildings in New York, San Francisco, and Los Angeles sit half empty, while commercial landlords beg lenders for extensions. Consumer debt has reached an all-time high of more than $17 trillion, and the average American household now carries nearly $8,000 in credit card debt. These are not abstract statistics. They're the pressure cracks forming beneath the shiny surface of optimism. Even the Federal Reserve, the same institution that fueled the last decade's euphoria with cheap money, is running out of ammunition. After printing trillions to prop up markets during the pandemic, it now faces a nightmare of its own making: high inflation, rising rates, and a fragile economy that can't survive either. Raise rates too much, and the system breaks. Lower them too soon, and inflation reignites. Either way, confidence collapses. And once confidence goes, the dominoes start to fall fast. What makes this moment especially dangerous is how globalized the risk has become. In 2008, the crisis was centered in the United States. In 2026, it will be everywhere. China's property market is already imploding, with developers defaulting on hundreds of billions in loans. Europe faces an energy crisis and crushing debt loads in countries like Italy and France. Japan's yen is collapsing under the weight of 3 decades of stimulus. And the US dollar, while still dominant, is under attack as nations form alliances to trade outside the SWIFT system. The entire global financial structure is interconnected, and when one pillar falls, the whole temple shakes. But here's the twist. While most people will see this as the end, the wealthy see it as a reset. To them, a crash isn't chaos, it's a clearance sale. They know that every asset, from real estate to stocks to commodities, will be marked down by fear. And when panic hits, they'll buy what everyone else is desperate to sell. That's how John D. Rockefeller became richer during the Great Depression, and how hedge funds made billions in 2008 while the world burned. The secret is always the same. Anticipate panic. Don't participate in it. Right now, the stage is set for that exact moment. The markets are eerily calm, volatility is low, and investors have convinced themselves that the Fed can manage a soft landing. But history laughs at that phrase. There has never been a soft landing after a debt binge this large. The calm before the earthquake isn't peace, it's pressure, and the longer it lasts, the bigger the explosion when it ends. The warning signs are flashing red, but most won't see them until it's too late. They'll be the ones asking, how did no one see this coming? While the answer was staring them in the face. The truth is, the wealthy always see it coming because they've seen it before. And when the ground finally shakes, those who prepared won't be crushed under the rubble. They'll be the ones building empires on it. For more than a decade, the American economy has been running on fumes, on cheap money, record debt, and blind faith in a system that everyone knows can't last forever. Since the 2008 crisis, the Federal Reserve has printed more than $8 trillion, injecting artificial life into markets that should have been allowed to reset. The result? A decade-long illusion of prosperity. Stock prices soared, real estate doubled, corporate executives celebrated record profits. But beneath the glittering surface, the foundation was rotting. What kept the machine running wasn't productivity or innovation, it was debt. That debt became the oxygen of modern capitalism. Corporations borrowed to buy back their own shares, pushing prices higher without creating real value. Consumers borrowed to maintain lifestyles their wages could no longer support. Governments borrowed to fund promises they couldn't afford to keep. The entire system turned into a financial pyramid, with one assumption holding it all together: interest rates will stay low forever. But the laws of mathematics don't bend to wishful thinking. When inflation returned in 2021, that illusion shattered. For the first time in decades, prices surged faster than wages, forcing the Federal Reserve to slam on the brakes. Interest rates climbed from near zero to over 5%, and suddenly, the same cheap debt that fueled the boom became an anchor dragging everything down. Corporate America, which once thrived on borrowing, is now suffocating under its own obligations. Zombie companies, businesses that can't survive without constant refinancing, are collapsing one by one. In real estate, commercial properties financed during the era of 2% loans are now rolling over at 7% or higher. Entire office towers sit vacant, their owners unable to pay the bills. Meanwhile, the US government finds itself trapped in the very cycle it created. With over $34 trillion in national debt, America now spends more on interest payments than on defense. That's not a statistic, it's a warning flare. Every time the Fed raises rates to fight inflation, it also increases the cost of servicing that debt. And when those payments grow faster than the economy itself, the system reaches a breaking point. You can delay the math, but you can't escape it. The middle class, once the backbone of the American dream, is feeling the squeeze more than ever. Household savings rates have fallen to their lowest level in 17 years, while personal debt continues to hit new highs. The illusion of stability is being propped up by credit cards and short-term loans. People aren't thriving, they're treading water in a pool that's slowly draining. Every extra dollar in interest payments is a dollar that doesn't go to food, housing, or savings. Globally, the consequences are multiplying. For years, countries around the world relied on the US dollar as a stable anchor. But as the Fed printed trillions and Washington borrowed recklessly, that trust began to erode. Today, nations from China to Saudi Arabia are experimenting with trade settlements outside the SWIFT system, building alternatives designed to reduce dependence on the dollar. It's not just geopolitics, it's survival instinct. The world senses that the American financial engine is overheating, and no one wants to be in the driver's seat when it finally explodes. The problem isn't capitalism itself, it's the distortion of capitalism. True markets rely on risk, discipline, and creative destruction. But for the past 15 years, those forces have been replaced by bailouts, stimulus, and artificial growth. Companies that should have failed were kept alive by cheap credit. Banks that should have collapsed were rescued by taxpayers. And politicians learned that every crisis could be postponed with another trillion-dollar temporary measure. Yet each postponement made the eventual collapse larger and more dangerous. Now, the system has reached what physicists call critical mass, a point where small shocks trigger enormous consequences. A minor bank failure, a missed debt payment, a political standoff over the debt ceiling, any of these could cascade into global chaos. And when that happens, the illusion of control will vanish overnight. But here's the paradox that defines every financial era. The end of one system always marks the birth of another. When the Great Depression ended, it created the foundations of modern finance. When 2008 broke the banks, it gave rise to digital currencies and decentralized markets. The coming collapse will do the same. It will wipe out illusions and force innovation. Artificial intelligence, energy independence, and hard assets like commodities will rise as the next generation's engines of growth. The question isn't whether the current system will end, it's how prepared you'll be when it does. Because once the engine stalls, the race doesn't stop. It just restarts with new rules. And those who understand the transition before it happens won't just survive the next decade, they'll own it. When the crash finally comes, the real battle won't be fought on Wall Street. It will be fought in your mind. Every financial collapse in history has followed the same emotional cycle: greed, denial, panic, and opportunity. The people who lose everything aren't the ones who lack intelligence. They're the ones who lose discipline. When prices rise, greed takes control. When fear hits, logic disappears. And in between those extremes lies the single greatest chance to build wealth that most people will ever have in their lives. The truth is, financial success during crisis isn't about predicting the future. It's about controlling your reaction to it. During the 2008 crash, millions of investors sold everything at the bottom, convinced that capitalism itself was collapsing. But a small minority did the opposite. They bought. They purchased homes for 30 cents on the dollar, acquired stocks in world-class companies trading below their intrinsic value, and built fortunes while the rest of the world panicked. What separated them wasn't luck, it was emotional discipline. Humans are wired for survival, not success. In nature, fear keeps us alive. But in finance, fear destroys us. The market punishes emotion and rewards patience. When everyone is euphoric, when your friends brag about profits, and the media celebrates a new era of prosperity, that's when the danger is highest. That's when you should quietly step back, raise cash, and prepare. Because when the crash hits and fear floods the streets, that's when courage becomes the most valuable asset on earth. Warren Buffett once said, "Be fearful when others are greedy, and greedy when others are fearful." It's not just a clever quote, it's the survival code of every successful investor in history. Yet following it requires going against everything your instincts scream at you to do. When the world looks safe, your brain says buy. When it looks terrifying, your brain says run. The wealthy learn to do the opposite. That's what makes them rich when others are ruined. In 2026, the same test will return. As asset prices collapse and news anchors shout about the end of the economy, the few who are prepared will quietly act. They'll use the cash they built up during the boom to buy quality assets at prices that once seemed impossible. They'll acquire real estate, businesses, energy assets, and precious metals that hold real value in a world drowning in paper promises. They won't panic because they understand a truth most people never learn. Crises don't destroy wealth, they transfer it. But surviving a crash isn't just about having cash. It's about knowing what to buy and what to avoid. During every downturn, there are two kinds of assets: those that survive and those that vanish. Companies with strong balance sheets, low debt, and essential products don't just survive, they dominate. They use the chaos to acquire competitors and expand market share. Meanwhile, speculative companies, meme stocks, and fragile startups vanish like spuke. The same rule applies to real estate. Prime properties in stable regions will always recover. Over-leveraged projects and speculative developments will become modern ruins. Even gold and silver, often romanticized as crisis saviors, serve a specific purpose. They won't make you rich, but they'll keep you solvent. They preserve purchasing power when currencies collapse and governments lose control. They're not investments, they're insurance. True wealth during crisis isn't about owning flashy assets, it's about owning resilient ones. The hardest part of all this isn't the strategy, it's the patience. During crashes, everything feels urgent. Prices fall fast, headlines scream louder, and every instinct tells you to act immediately. But fortune doesn't reward speed, it rewards timing. The greatest investors in history, from Rockefeller to Buffett to Soros, all understood one principle: wait until fear reaches its absolute peak, then strike. The deeper the panic, the greater the reward. And yet, emotional mastery isn't just for investors, it's for ordinary people too. If you can keep your composure when your company lays off workers, when your neighbors panic, and when the headlines scream meltdown, you'll already be ahead of 95% of the population. Because panic doesn't just destroy portfolios, it destroys opportunities. The calm mind becomes the rarest and most valuable asset in the world when everyone else is losing theirs. When the 2026 crash hits, it won't just test balance sheets, it will test belief systems. It will separate those who understand history from those who repeat it. Those who prepared will see chaos as confirmation. Those who didn't will see it as the end. But for the few who stay calm, calculated, and courageous, the coming storm won't be a disaster. It will be the beginning of something far greater, a chance to rebuild wealth from the ground up while the rest of the world is still sifting through the rubble. Every financial collapse feels unique while it's happening, but the path to wealth through chaos has never changed. It's built on three timeless principles: preparation, discipline, and timing. The investors who emerge from crashes richer than before don't rely on luck or prediction. They follow a blueprint that has worked for centuries. And if you understand it now, before the world panics again, you can ride the 2026 collapse like a wave instead of being crushed beneath it. The first rule is timing, not prediction. No one can call the exact day or hour a market collapses, but the signs always appear before the fall. Look around. Consumer debt is exploding, corporate profits are flattening, and government spending is spiraling beyond control. Central banks are trapped, forced to choose between inflation or recession. These are the tremors before the earthquake. Smart investors don't wait for the official declaration of crisis. They position quietly while everyone else still believes they're safe. In 2007, that meant selling speculative real estate and building cash reserves. In 2025, it means the same thing. Lighten up on overvalued tech, reduce exposure to risky leverage, and build liquidity. Cash isn't cowardice, it's ammunition. The second rule is know what survives. During every collapse, entire sectors disappear while others rise from the ashes stronger than ever. Companies with strong cash positions, low debt, and indispensable products not only survive, they expand. Think energy, food production, infrastructure, utilities, and defense. When chaos hits, people still need to eat, travel, communicate, and protect themselves. These industries anchor the next cycle. Meanwhile, speculative assets, cryptocurrencies built on hype, meme stocks without earnings, and companies dependent on zero-interest loans will implode under their own weight. The next transfer of wealth will favor the tangible over the virtual, the real over the imagined. The third rule is diversification of geography and value. The coming reset won't hit every nation equally. In 1997, Asia's financial crisis devastated Thailand and Indonesia, but created opportunities in South Korea. In 2010, Europe's debt meltdown punished Greece and Portugal, while strengthening Germany. The 2026 crisis will follow the same pattern. Capital will flee from unstable regions into safer ones. Investors who spread assets across currencies, commodities, and borders will preserve their wealth while others are trapped. Owning a rental property in a stable market, holding part of your assets in precious metals, or diversifying into emerging economies can be the difference between losing everything and rebuilding quickly. But there's one more layer to the blueprint that most people miss: psychological leverage. While everyone else is paralyzed by fear, your advantage isn't just financial, it's mental. History rewards those who act when others hesitate. During the Great Depression, John D. Rockefeller built generational wealth while banks failed. During 2008, those who bought assets at 70% discounts tripled their net worth within 5 years. The reason is simple. Markets are designed to transfer wealth from the impatient to the patient. Fear creates prices. Courage creates profits. To prepare, you don't need millions. You need a plan. Build cash reserves not for safety, but for opportunity. Identify quality assets now, before panic discounts them to fire sale levels. Study balance sheets, track debt-to-equity ratios, and understand the industries that will still matter when the dust settles. When the crash begins, don't freeze. Observe. Let the panic play out. When you start to see blood in the streets, figuratively, when even the optimists give up, that's your entry point. That's when the next decade of wealth is quietly written. And remember, government intervention will not save everyone. Politicians will promise relief. Central banks will flood the system with liquidity, and bailouts will target the powerful, not the public. Don't rely on them. The system is designed to protect institutions, not individuals. Your protection comes from foresight. When the Federal Reserve inevitably pivots back to money printing to stabilize markets, inflation will surge again, and real assets, land, commodities, productive businesses will explode in value. Those who positioned early will ride that wave. Those who waited for certainty will drown in it. The next wealth transfer won't be measured just in dollars. It will be measured in perspective. It will separate those who see fear as a signal from those who see it as a sentence. It will move ownership of the world's assets, real estate, energy, infrastructure, even digital networks, from the reckless to the patient, from the leveraged to the liquid. And while most will call it a crisis, the few who understand it will call it by its true name: opportunity. Because history doesn't reward panic, it rewards preparation. When the 2026 crash hits, most will lose because they chased comfort when they should have chased clarity. But those who see the pattern, hold their nerve, and execute the blueprint won't just survive. They'll own the future. Every generation faces a moment that defines its financial destiny. For our grandparents, it was 1929. For our parents, it was 2008. For us, it will be 2026. Each crisis feels like the end of the world while it's happening, but history shows it's always the beginning of something new. After every collapse, fortunes change hands. Those who panicked lose everything. Those who prepared inherit the future. The same will happen again. This isn't a call to fear, it's a call to awareness. Because once you understand the pattern, fear becomes fuel. When markets crash and headlines scream collapse, you'll see what most can't: the greatest clearance sale in history. Quality assets will be discounted beyond reason. The weak will sell, the wise will buy. And years from now, when the dust settles, the world will look back and say that this exact moment was when the next generation of wealth was born. Every economic reset is brutal, but it's also cleansing. It clears away excess, resets illusions, and rewards discipline. The 2026 crash will not destroy capitalism. It will purify it. And those who see clearly through the fog of fear will rise when others fall. So the question isn't whether a crash is coming. The numbers already answered that. The question is what you'll do when it arrives. Will you panic like the many or prepare like the few? Because when the dust finally settles, only one truth will remain. Crashes don't destroy wealth, they transfer it. The only question left is, will it transfer to you?